Valens Research, Uniform Financial Analytics.
ServiceNow, which is a software platform business, a SaaS business that really helps companies operate their their infrastructure, for lack of a better word. When you think about what ServiceNow does, right? I mean, they help, if you will, basically turn a lot of these things like data analytics, encryption and security, IT management systems. They actually help manage those things for companies as a service, right? Is literally what they do. Now, the really interesting thing about ServiceNow and what it highlights is not just this chart here, which shows you on an as reported basis, ROAs are basically 0 to negative every single year for ServiceNow over the last, since it's been public and since we've had data. I mean, this was the best year ever in 2020 on an as reported basis, and it was 1.7%. So totally misrepresenting profitability, which, by the way, has been strongly profitable since basically all the way back in 2014, 2015. But what's even more powerful than that is you can get more basic than return on assets and asset growth. You know, we know a lot of people talk about companies in terms of EPS growth, and PEs. And if we just look at that for this company, ServiceNow, we say, let's do the most simple and basic thing that we can look at. Let's look at the company's EPS. What you can see is you would get directionally wrong insights about ServiceNow's performance during the pandemic. Right? You think about literally a company that is helping IT and helping companies, not just IT, but really the tech and growth part of IT, right? Not just maintenance and back office, but how it can help leverage growth in terms of workflow automation stuff, artificial intelligence, analytics, et cetera. Literally, this is a platform that lets people do this without having to be in the office. It should be perfectly in the wheelhouse of the at-home revolution. And yet, on an as-reported basis, it looks like EPS cratered in the last year from $3.18, actually $3.40, sorry, all the way down to 58 cents, 59 cents. It looks like this company collapsed when it should have one of its best years ever. It's playing into its core competency. Well, the reality is, the reason why you think that's the case is because of bad as-reported data. When we look at the uniform accounting data, we see something totally different. We see a company with a secular growth trend of EPS. EPS didn't fall 80% last year. It rose from $2.80 to $3.40. It was up more than 20%. Right? This is a company with phenomenal fundamental tailwinds that you can actually see when you're looking at the uniform accounting data that represents economic reality for this business. And that's what's so important is, I hope that you're seeing this time after time. You use bad as reported data and you don't see the reality of what's going on for a business. You can't make investment decisions. You also, for what it's worth, even if you did this for just one company, you then can't benchmark it against peers. You can't understand, is this cheap or expensive relative to its peer group, relative to my other opportunities? And that's what's so powerful about uniform accounting data.
Valens Research, the world's leading source for uniform financial analytics.